Good morning. It's Jeffrey Christian from New York, CPM. This is our Gold Yearbook 2021 launch. And I'm joined today with Carlos Sanchez, who from CPM works out of Peru at present, and Rohit Savant, our Vice President and Director for Research and the primary author of the Gold Yearbook and our other precious metals research these days. Format today is I will talk about the overview for the market a little bit and go into some of the economic issues. I will talk about the Turkish Central Bank and what it has been doing because it's an interesting thing. There are a couple transformational and, a couple secular issues transforming the gold market, and a couple cyclical developments that we'll talk a little bit about. Then I'll kick it over to Rohit and let him do the heavy lifting, talking in greater detail about investment demand, central bank transactions, supply, fabrication demand. We'll bring it back to a question and answer period, and we'll go until people start signing off for lunch. So good morning again. We have been producing annual gold, silver, platinum group yearbooks, and before that we called them surveys, since we were created in 1986. So 35 years we've been doing this. It doesn't get old. The market keeps changing and keeps giving us new things to talk about. We actually go back further to around 1970 or so, when J. Aaron and company created a precious metals research department, which was rather unique within the context of commodities trading companies. And in the 1970s, they were producing gold and silver annual reviews and outlooks. I took over that department at J. Aaron in 1980. We merged into Goldman Sachs. And then in 1986, we spun off. And back in the day, there was Consolidated Goldfields, which was a major mining company, and they had a commodities research group, and CPM Group had, or J. Aaron had a commodities research group. We shared a lot of the consultants between us, and we swapped notes a lot. And that lasted until about 1989, when Consolidated Goldfields was broken up by Lord Hanson. He bought it and broke it up and actually bought it for the Amy Roadstone gravel and got rid of all of the gold assets over time. In silver, there was Handy and Harman and J. Aaron. And when we left J. Aaron Goldman Sachs in 1986, Handy and Harman actually stopped producing its annual silver survey, which dated back to the turn of the 19th century into the 20th century. And they gave us their files and said, okay, now that you're no longer part of J. Aaron Goldman Sachs, we don't need to do this anymore. Here are our files. Good luck, have fun. Platinum Group Research, we produced the first book on platinum group metals in 1981 and have been doing it ever since. Since we left Goldman Sachs, we have been independent. We left Goldman Sachs expressly for that reason. We thought that research should be independent of trading, investment banking, and equity sales. And we haven't. In the mid-1990s, we created a system of sponsorships for our reports. And we're proud to say that we still have a number of sponsors throughout the precious metals market. We try to be balanced. So we have producers like Goldfields Limited. We have scrap companies represented through the Institute of Scrap Recycling Industries. We have refiners like Sabin, institutional investors like Noah Capital Markets in South Africa, Monex Precious Metals and Kitco Precious Metals, two of the largest retailers and wholesalers, I guess, of precious metals. And Corlin Economics Report has joined us this year, a well-respected internet-based company that talks about economics, including precious metals. And they have interviewed us for years, and we have brought them in as a sponsor this year. We have three partners in China, the China Gold Association, China National Gold Corp, and Jingyi Gold. They translate and publish our reports on gold and PGMs into Chinese and distribute them in China. And they see themselves more as partners than sponsors. This year, we also have started breaking out media partners with Kitco showing up here because you have Kitco Metals and Kitco Media, and they are in fact, I guess, distinct operating affiliates of each other. Glacier Publishing, which produces the Northern Miner and has other mining assets, including databases on mining and such. Metals Daily, Ross Norman's company. Ross goes without saying as one of the foremost guys who's been around for decades in the precious metals, and Prospector News, which covers the Canadian mining industry. And then we have distributors. These are companies, Gold Blocks, Gold Silver Central, Southeast Asia Consulting. Those are all Singapore-based companies involved in precious metals and precious metals oriented investing. Introact distributes our research to institutional investors. Prospector News, we have them on both places, and the Morgan Report, which also is distributing our reports. And it's hard to say, you could call them a media partner, but they do much more analytical work than reporting. So we count them as a distributor. And we want to thank all of those people because the sponsors and the partners, they help underwrite the research program that gives you a 219-page gold yearbook every year for the low price of $160 US. So let's talk about gold. Record gold prices last year, we spiked up over $2,000 for the first time ever in early August. Price came down, but it has remained at higher levels than we've probably seen. Well, we saw them in these levels in 2019, and we saw them briefly in 2011, 2012. So we're still at very high levels. On an annual average basis, we also have risen to record high prices. That has been caused by investment demand rising. So let me just give you the highlights. Investment demand, you can see on this chart, and Rohit will show you a full page chart later, but I just put it in here to highlight it. You can see that investment demand fell to very low levels, really from 2014 through 2019. In 2018, 2019, you saw 17.5, 18.2 million ounces of gold being bought, physical gold on a net basis by investors. Some investors were selling, so gross purchases by investors of physical gold was higher than that, and some investors were selling, so you had gross sales. But on a net basis, you had that, and that was relatively low. You can see here from 1960 to 2000, you used to have a situation where things would get bad financially, economically, politically, and for a year or two, investors would buy more than 20 million ounces, and that would drive the price higher. And then things would get better, and investors would buy less than 20 million ounces. And investors are bearish; they don't sell their gold on a net basis; they just buy less. And you've had 3 years since 1966 in which investors were net sellers, and very small amounts. You could hardly see the little red bars in those 3 years. But in 2000, you started seeing an upward shift in the investment demand curve. And more investors were buying more gold for a longer period of time in more parts of the world than ever before. And they, in fact, from 2002 to 2013, bought more gold than they had bought in the 5-6 millennia prior to 1966. Anglo-American, which really created the first gold report and was the progenitor of both the Consolidated Goldfields research work and the J. Aaron CPM group research work. They estimated that there was about 330, 340 million ounces of gold held by private investors in 1966. And investors bought far more than that from 2002 to 2013. Then we went into the cyclical bear market and investors bought less. And last year they came back in spades and they bought 44.5 million ounces on an estimated basis for 2020. So more than double the amount. And the price responded. by rising sharply to record levels. Our expectation is that investment demand is going to stay high this year. We have a 42.8 million ounce initial projection for this year. The first quarter has seen pretty strong demand. Our expectation is we'll see a little bit more weakness in demand and possibly sideways movement in prices in the second and third quarters. But we think that by the fourth quarter, people will be resuming their enthusiasm for gold, by which I mean the economic and financial and political environment will start looking more hostile, and people will continue to buy gold because of everything that they're seeing around them. That's the big thing. Central banks bought less gold last year. That's the second chart here. You can see they bought about half as much gold. And of the central banks that were buying, some of the guys who have been buyers consistently since 2008 or so, Russia and China, were absent the market. China hasn't bought since late 2019. Russia was buying in the first quarter, but when the oil price fell sharply, when the Saudis started the oil price war with Russia in April, the Russian central bank stopped buying gold and adding it to its monetary reserves, and it hasn't been back yet. Kazakhstan, which was buying in conjunction with Russia in a way, buying from domestic production, Kazakhstan actually sold gold in the first three quarters. They bought it back. They bought gold back and added to their reserves, so they were net buyers by the end of the year. But for the first three quarters of the year, they were net sellers. Central banks are much more price sensitive than private investors. Rohit will talk about this some more, I'm sure. But basically, when investors bought less gold from 2014 to 2019, the price came down and central banks bought gold, more gold. When investors came back into the market in 2020 and they bid the price higher, central banks said, yeah, we're interested in buying gold, $1,200, $1,300 an ounce, but $1,700, $1,800, $1,900 an ounce, the investors can buy it. When they get disappointed and they start selling, then we'll buy again. So you saw central banks pull back. Turkey accounted for 65% of net official purchases and 48% of the gross purchases. And I'll talk about Turkey in a second a little bit more, because that's one of those transformational issues that I mentioned up front. Fabrication demand, price rises, incomes fall, everybody goes into panic mode. Fabrication demand declined about 17.7% last year. You had some people selling gold jewelry and fabricated items in order to raise cash to live. So fabrication demand fell about 17.7% last year. We project about a 5.3% recovery this year. People are doing better, but they don't think that they're necessarily out of the woods. Mine supply fell 4.1%, partly because of lockdowns and shutdowns in the first half of the year and into the second half of the year in various jurisdictions because of the pandemic. Total supply actually only dropped 0.7% because you saw an increase in scrap being recovered from jewelry and other items as people sold their jewelry in order to raise cash. So that's the overview of the market last year. Now, one of the things that's happening is that some of the bullion banks are getting out of the business, or they're scaling back severely their precious metals trading operations. And that's important because what it's done, it's important for several reasons. One is that it has reduced the number of players, the breadth of the market as market makers, people who stand ready to buy or sell regardless of what their counterparts want to do. It reduces the breadth, the number of participants as market makers, and it also reduces the depth, the liquidity of the market. So the liquidity of the market has suffered. That means more volatile prices, and it probably means has contributed to the higher prices too. That factors into the second point, which is that one of the things that we saw last year is that in bullion banks, which had been accumulating gold and silver to record levels into 2020, as investors were selling. Remember, I was saying you had gross sales, which were relatively heavy from 2013 into 2019. That some of that metal was accumulating on the gold books and silver books of the bullion banks. And as their senior management was saying, we want to reduce our exposure to precious metals, they found that they actually had increased their exposure by virtue of the fact that their market-making capacity, in their market-making capacity, they had picked up record amounts of gold and silver. So what we saw in the second and third quarters of last year was some bullion banks selling their gold and silver. Demand was up, it was easier to sell, and buying ETF shares, GLD and SLV primarily. Then those shares, those are shares, so they get transferred from the precious metals trading desk to the equity trading desk. And then the equity trading desk starts to sell them off. So that's important for a couple of reasons. I mean, first off, understand bullion banks have always been involved in ETFs, but we saw a new type of policy. And it was basically predicated from the senior management of saying, wait a second, we want to reduce our exposure to precious metals, and you've got record amounts of metal. So that was how they disposed of it, or at least got it off of the books of the precious metals trading desk, bullion desk, and onto the equity trading desk, right? Now, it's also important because a lot of people look at ETFs and they buying the net creation and or reduction of shares, which is done through the delivery of gold or silver to allocated accounts for the ETFs. And they look at those net additions and subtractions of those shares as a surrogate for investment demand. And you saw about 330 million ounces of silver added to ETFs last year, and you saw about 28 million ounces of gold added to ETFs. At the peak, it was over 30 million ounces. In the fourth quarter, some of those equity desks started liquidating their gold shares. They continued in the first quarter of this year. They've also liquidated some of their silver shares. And people who don't understand that this is going on will say, oh my God, investors bought 330 million ounces of silver last year. They bought 30 million ounces of gold. And oh my goodness, investors are now selling their gold ETFs. Investors clearly were buying a lot of gold and silver ETFs last year, but the numbers were distorted by the bullion banks coming in. And you have to understand that. So you can't say, oh my goodness, investors were buying record amounts of these metals. They were buying a lot of metal, very large amounts, but those ETF figures have been distorted. And strangely enough, it's been largely overlooked, partly because, look, the banks aren't going to say, oh yeah, this is what we're doing. There's no obligation to do that, and it's not really in their best interest to do it. And by the same token, other people haven't really picked up on it. The other thing is the Turkish central bank. And as I said, Turkey represented the largest buyer of gold among central banks last year. And what they were doing is they have gold bonds and they have gold leasing schemes. And they created those in 2017 to help Turkish citizens. And Turkish citizens can buy gold bonds, pay for them with gold, bullion, coins, or 22 or 24 karat jewelry. And they can lease their metal to the banks through the commercial banking system, ultimately going back to the central bank. It shows up on the central bank's books. And they do this to provide liquidity to investors in Turkey who hold a significant part of their wealth in gold. Last year, that became much more important because the Turkish citizens were facing the pandemic lockdown. They were facing sanctions from the US and Europe. They were facing an economic recession. They have a hostile relationship with Russia. No one's ever really claimed responsibility for blowing up the Istanbul airport a few years ago, about a year or so after the Turkish government mistakenly shot down a Russian bomber jet over its territory while the Russian jet was bombing people in Syria. And you have a civil war in Syria, and you have the ongoing relationship between Turks and Kurds, which is, to say the least, problematic. So there are a lot of things going wrong in Turkey last year, and a lot of people turned in gold for gold bonds and gold leasing programs in order to raise cash to live. And that's really important because the Turkish central bank does this, and the Reserve Bank of India does it. But I'm not sure that any other central bank in the world is actually using gold for anything other than a monetary reserve asset. The Turkish central bank and the Indian Reserve Bank actually are using gold for monetary purposes, which is kind of interesting and cool. And it's kind of strange that no one else is using it. I want to talk now about monetary policy, interest rates, inflation, and gold, because it's one of the big topics. First off, let's talk about inflation and gold. Oh, except we have to get back to that chart. Okay. First off, the relationship isn't what it was, and it isn't what a lot of people think it is. People think of gold as an inflation hedge, and it is. People say, well, for many years in the 80s and 90s, oh, is gold dead as an inflation hedge? And our answer was no, inflation is dead. Gold does well as an inflation hedge for catastrophic inflation, 7% in the United States or higher in other countries. And you saw in the 1970s, when there weren't a lot of other financial assets that you could hedge inflation with, including tips, did not exist. You saw that gold and silver were the inflation hedges. And inflation was problematic, getting up to 14% in 1979, 1980. And people bought gold as inflation. But after 1982, and this comes in with monetary policy, Paul Volcker took over the Fed in 1979 and changed the way central banks work forever. And a lot of the things that people don't seem to really fully comprehend really came out of 1980, 82, 83. Paul Volcker inspired policies, not only at the Fed, but they were coordinated with about 8 central banks around the world. What you saw, just to be brief, we had high inflation, we had high interest rates, we threw ourselves into a double dip recession, which was the biggest recession since World War II. And we had an international debt crisis. It started in Eastern Europe in 81, it spread to Latin America in 82. And the Fed basically destroyed inflation with that double dip recession. It remonetized, and I'll get back to that with monetary policy in a second. It remonetized to get us out of that recession when things got nasty. But what we saw was that inflation fell in 1982 and 83. It dropped below 4% or so. And it really hasn't picked up since then. And in fact, there's been a downward trend from the mid 1980s until recently. CPM Group is on record saying, we're not concerned about inflation. We're much more concerned about deflation and disinflationary pressures. And central banks are too. Most central banks, right now the Fed says it'd like to see 2% inflation. It can't get there. Everything it's doing is not pushing it up there. Why? Well, first off, money supply doesn't necessarily have an inflationary consequence. But, inflation comes from not only money supply being excessive, but also from the real economy. And if you look at the real economy, you have surplus labor, surplus manufacturing, surplus commercial real estate, surplus retail capacity. There are surpluses of all of the inputs right now, and that has disinflationary and deflationary pressures, which are offsetting the inflation. Now, you do see inflation. The inflation is showing up in the stock market, and up until recently, the last couple of months, it has shown up in the bond market and interest rates. So it's been financial market inflation that you've seen, not general price inflation. And that's very important to remember. Gold, if we ever see inflation again, gold will do very well as an inflation hedge. But we don't necessarily see inflation as coming back in a problematic way, and neither do the central banks. What's really been important is the increase now in interest rates. And we've seen really since February an increase from about 1% to about 1.74% 2 days ago. It came off to about 1.68% yesterday for the 10-year Treasury bond. And that has caused gold prices as well as other asset prices to fall. But you can see from the right-hand chart, while we've seen a big increase in interest rates on a nominal basis, they're still at historically low levels. And that leads to the title here, A Tale of Two Markets. You have shorter term investors who use valuation models, and any increase in interest rates cause those models to say, okay, if interest rates go from 1.0 to 1.7, gold prices and oil prices and everything else should be marked down, because the potential return or the anticipated return or the projected return has to match a higher interest rate in the benchmark US Treasury bond. So those shorter term guys adjust their portfolios, and you see selling and the gold price comes down. Longer term investors who are more macroeconomically and fundamentally driven say that's really just short-term static to me, because the reality is that interest rates are very low and they're probably going to continue to be low. Now, in addition to that, it's the real inflation adjusted rate that matters more, and that is still negative. You can see that it's been negative really since the beginning of this year, and we had a little bout back in 2012, 2013. But if you look at it on a T-bill rate, as opposed to the T-bond rate, you can see that we've had negative T-bill rates, short-term rates, really since 2007, 2008, for most of the time. A couple spurts above it, but we've had short-term negative T-bill rates on an inflation-adjusted basis for about 12, 13 years. That compares to the historic norm of 1973 to 1979, 1980, which was about 6 years, 7 years. So we are in a long-term period of time where you're seeing low interest rates and negative real interest rates, not only with treasuries, but across the interest rate market. And that's very supportive of investment demand for gold, because let's be honest, if I'm an investor, I'm not going to say, oh, gee, I can lock in 1%, 1.7% now for the next 10 years with my treasuries. I think I'll do that. No, it takes a much higher level. How much higher? 3% real interest rates. Historically, weaker gold prices show up when real interest rates are over 3%. Plug in 2% nominal inflation, nominal rates over 5%. I don't know anyone, certainly not the Fed, but the Fed's track record on calling interest rates is not the greatest. I don't know anyone who's talking about 5% nominal treasury T-bond rates in the near term. Now, the chart on the left is very interesting because this is a dispersion chart. Higher, lower gold, real gold prices, higher, lower real interest rate changes. It's the rate of change that matters. You have to measure apples to apples, not apples to oranges. So you look at the change in real interest rate and you look at the change in gold prices, and you have a negative 16% correlation. In other words, not very well correlated. And if you look at it differently, you can get down to 0% correlation, which is why gold is a great hedge and safe haven and portfolio diversifier, because it's uncorrelated. And you can see from this dispersion chart that it's all over the place. There are times when gold prices and interest rates are rising together. There are times when they're falling together. There are times when they're moving in opposite direction. Interest rates are rising and gold prices are falling, or interest rates are falling and gold prices are rising. Over time, and this is 1968 to the present, you see that interest rates are important, but what's really important is what's driving interest rates higher or lower. And if you look at that quadrant where you see falling gold prices and rising interest rates, it's when real interest rates are over 3%. So we're not spooked by inflation. We're not spooked by the idea that higher interest rates are going to distract a lot of money from gold. A little bit for those short-term valuation guys, but not a lot. Now, money supply. This chart, I was going to pull up a chart prior to 2020 so that you could really see this, but the blue line is M1 money supply, and the red line is inflation. And as I said, you've got up to 14% inflation in 1979, 1980, Paul Volcker really put on the screws, raised interest rates at 22% on a nominal basis, threw us into the deepest recession in the post-war period at the time. We had a sovereign debt problem. We had Mexico, Brazil, Argentina, and Chile all about to default on their bonds in 1982. Volcker called central bankers of the world to Washington. They had a meeting and they just opened the sluices. And you saw, it doesn't show up here because we have this big number from 2020, which I'll get to, but we saw about 14% in growth in M1. And over here on the left-hand chart is MZM, which replaced M3, it's broad money. That 14% in M1 led to about a 37, 38% increase in MZM. As the central bank provided liquidity to get us out of the recession, the banks lent that to people who spent it. So you had this multiplier between M1 and MZM, which you haven't seen in recent crises. And that's very important to pay attention to. People looked at that. Now, July 1982, when Volcker had that meeting and opened the sluices, gold was down to about $284 an ounce. And investors were very pessimistic about gold. And then they saw all of this money coming into the market and they said, this has got to be hyperinflationary. And they bought gold and they bid it up to $500 by December of that year. First quarter of 1983, we're out of the recession. Nicholas Brady is the Treasury Secretary. He's created Brady bonds and he's sopped up the liquidity in the sovereign debt of Latin America, basically saying if you private investors don't want Latin American sovereign debt, we'll buy it from you and give you Treasury bonds in replacement. And we were out of the recession, we were past the debt crisis, and we had the Reagan administration take a $58 billion Carter deficit and make it a $320 billion deficit. So Nick Brady said, well, we can handle that. We'll sell bonds and we'll sop up all that excess liquidity before it has an inflationary consequence. And you saw that right here. We had 14% growth and then it dropped down to about 5% growth. Inflation had fallen and it never got up. 1987, we had a similar situation with the stock market. 1991, we had a recession. 1997, we had the Southeast Asian currency crisis. 1998, we had the Russian bond default. 2001, we had the tech bomb, which is very important as a lesson for anybody who's buying Tesla or Bitcoin. 2001, we had that. 2007, 8, 9, we had the Great Recession and the global financial crisis. Each time, monetary authorities pumped as much money as was needed to get us out of that crisis, and then they sold bonds and sopped it up before it had any inflationary consequence. So all of that time, you've seen that over and over again, and it hasn't had an inflationary consequence. Now, after 2009, it took a lot longer to sop up that liquidity, really into 2017, 2018. This one we have to explain. Okay. In May of 2020, the Fed changed the way it measures M1, and it included bank savings accounts in with bank checking accounts and other short-term deposits. So M1 all of a sudden had $8.6 trillion added to it in May 2020. They implemented that data change in February of this year, and they took the change of adding in savings accounts back to May. So all of a sudden, people start seeing this gigantic increase in money supply. But if you look at the data, about 2.8 trillion, which is an enormous amount of money, was actually due to monetary policies, the first COVID response program, the first trillions of dollars that the US government was pouring into the economy because it was locking it down. 2.8 trillion from monetary policy and 8.6 as an accounting change. 3/4 of the increase in M1 from May 2020 forward actually represented an accounting change, not monetary largesse, right? So the monetary largesse is bad. It's very critical and it's very worrisome. But history over the last 30, 40 years shows us that astute and agile monetary authorities might be able to sterilize the inflationary consequences going forward once we get into an economic recovery that's sustainable. We're obviously in uncharted territories because it's much, much higher than it has been. We also have the predecessor of the post-2009 sopping up, which took a lot longer than all of the previous ones. So I'm not saying that there aren't risks there, but what I am saying is that there are tools available to sterilize the inflationary implications of this kind of monetary largesse if we have adroit enough fiscal and monetary authorities. That's a big if. One more chart about the Turkish central bank, just to show you. Turkey and the Reserve Bank of India have done two things. This goes back here. This is the reserve options mechanism, which they implemented. They announced it in September of 2011, implemented it in October of 2011. Now, go back to September 2011. The United States Treasury was downgraded. We were in the depths of a sovereign debt crisis. Athens was on fire. Greece was facing default. You had hundreds of billions of dollars of Greek sovereign debt held by commercial banks and institutional investors who were really suffering from it. And the ECB did not have the legal mechanism to do a Brady bond. They got that legal mechanism in 2012, and all of those bonds, or most of those bonds, were sold by the private sector into the European central banking area, which has a completely different way of looking at insolvent EU central bank bonds than the private sector. Problem solved. But in 2011, the problem was not solved. You had riots and protests in Greece. You had the ECB hands tied. They couldn't really deal with it. You had an enormous amount of gold, silver, or gold, dollars, and euros pouring into Turkey. And Turkey was looking at the EU, its major trading partner, and saying, we have real problems here. So they created this reserve option mechanism. They said to the commercial banks that are members of the central bank network, if you have gold, dollars, and euros, you can meet 10% of your reserve requirements with gold and 10% with dollars and 10% with euros. And then in January of 2012, they raised the gold portion to 30%. And you started seeing all this gold show up in the Turkish central bank things, because if you have gold that is on an unallocated basis in a commercial bank, and all of a sudden the commercial bank is pledging that gold to the central bank as part of its reserves, that gold shows up on the central bank balance sheet. A lot of people didn't realize that, and they say, oh my gosh, the Central Bank of Turkey, which hasn't bought any gold since 1991 or so, all of a sudden is buying 10 million ounces to 12 million ounces of gold. No. This was gold through the reserve option mechanism. Then in 2017, they created the gold bond and the gold leasing scheme. And you saw a few million ounces show up on their balance sheet from that. And then last year and this year, 2019, 2020, you saw a very sharp increase. And it's really genius. The Turkish Central Bank and the Reserve Bank of India have said, not only do we want gold in our monetary reserves, and not only do we want gold in the private sector wealth of our country citizen, but we want to have monetary instruments that allow those citizens to use that gold as monetary instruments. And the thing that I don't understand is, A, why other central banks aren't doing that. Because as you look at central banks and you find that they all want to move away from the hegemony of the US dollar, but they need to have more liquid non-US dollar assets, euros, domestic currencies, currencies from around the world, and gold. One of the things you need to do is open up the banking system to allow it to use that gold, so that people can say, I can actually afford to own gold now because I can use it in an emergency just as well as I can use Turkish lira or US dollars. I'm going to turn the program over to, if it would let me do this, I'm going to turn this over to Rohit now and let him take over. And I'll listen, and then I'll come back, and Rohit and I will answer questions at the end of the program. Carlos will run that process. Rohit, take it over.
Thank you, Jeff. Good morning. So what I'm going to start talking about here with is gold investment demand. And what you're looking at here is net gold investment demand over the past several years. During 2020, this demand rose to its highest level since the Great Recession of 2008-2009. The sharp increase in demand should not really come as a surprise, given the market environment last year. You had the pandemic, which resulted in massive fiscal and monetary stimulus. You also had political risk in the form of the US election and Brexit. And all of these factors collectively were sufficient to drive gold investment demand and prices higher during 2020. Now, many of these factors that pushed gold prices higher during 2020 existed even before the pandemic, such as a growing government debt, loose monetary policy. The pandemic, however, we believe has entrenched these issues and will also make it a lot harder to reverse these problems in the future. So we think this is something that will help provide long-term support to gold prices as well as gold investment demand. This year, gold investment demand is expected to be slightly lower than levels observed in 2020. Nonetheless, investment demand is expected to be very high by historical standards. We do expect that investors will be large net buyers of gold during 2021. They are not expected to chase the price of gold higher as they did last year, however. So instead, we think that investors will increase their purchases whenever we see softness in prices. And we saw that, for example, in the case of US Mint gold coins earlier this year. When the price softened, you saw a pretty large rush and increase in demand for those products. But we do think that such buying patterns, while they will help to keep and provide downside support to gold prices, because of this pulling back in fresh purchases whenever prices go up, what the impact on prices will be that they remain at elevated levels but are unable to rise strongly as we saw last year. So that let's talk about inflation. Jeff already elaborated a lot about our thinking on inflation. We do think that inflation will rise in coming quarters, but we do not expect it to be rampant or expect to see runaway inflation as we saw in the 1970s, for example. We expect a moderate level of inflation, which should not force the Fed to push rates up sharply. And this environment of moderate inflation coupled with low interest rates should be good for numerous assets, including commodities such as gold. With regards to the dollar, CPM Group does not expect a sharp decline or a collapse in the US dollar. Instead, the expectation is that the dollar will move sideways with a downward bias. When you look at the dollar's fundamentals in isolation, the low rates and the high debt levels would suggest a sharp decline in the value of the currency. However, the dollar derives its value from other currencies, and in comparison to its peers, the US economy is on a better, the US economy as well as the US dollar is on a better and a stronger footing. This is another reason why we think that the dollar will hold up, which is that there's a tremendous amount of demand for the currency globally in the financial sector. What we're looking at in the chart is the breakdown of Forex holdings at central banks, and around 60% of these holdings are in USD. And they've held this level pretty consistently over the past 2 decades. Similarly, with private wealth, around 75% of it is denominated in US dollars. So as we can see, there's a tremendous amount of demand for the currency, which will prevent any sort of crashing or sharp decline in value as some in the market are anticipating. With regards to equity markets, we think that equity markets would potentially continue to rise in coming years. They do look a little bit top heavy, which exposes them to the potential of increased volatility. And also the gains are not likely to be as strong as they've been in the past few years. So both those factors together, we think, will bode well for gold as a portfolio diversifier. So what you're looking at here is gold ETF demand. Gold ETF holdings rose to record levels last year with record net additions as well. Gold held by ETF stood at about 125 million ounces at the end of 2020, with about around 31 million ounces added on a net basis over the course of the year. And as explained before, not all of these purchases were made by investors, as some of the bullion banks were selling gold bullion and buying gold ETF shares to replace their gold exposure, as Jeff was explaining before in the presentation. This chart shows gold coin fabrication, and after several years of declining, fabrication for gold coins rose during 2020. It rose to the highest level since 2013, and it could have risen even more if it had not been for the restriction and constraints on production because of COVID. Fabrication of and demand for these coins is likely to rise this year as COVID-related restrictions ease as the year progresses and demand increases for these coins from long-term buyers that are typically sensitive to price. So as we see the price relatively lower compared to last year, we are already seeing a bit of an increase in demand from these longer-term buyers. So with that, let's talk about central bank gold demand. Central banks were net buyers of gold during 2020. However, their net purchases were down pretty sharply compared to 2019. So in 2020, central banks absorbed about 7.1 million ounces of gold on a net basis, which was down from about 17.6 million ounces in net purchases during 2019. Now, one of the primary reasons for the decline in central bank demand during the year had to do with the sharp run-up in gold prices. But in addition to that, you had some central banks not reporting any additions to holdings, such as the PBOC. Meanwhile, you had the Russian central bank, which has been a large and consistent buyer over the past several years, holding off on any fresh purchases since April 2020. And lastly, another reason why you did see this softness in central bank demand last year was because you had central banks generally preoccupied with handling COVID, putting this whole gold purchases buying on the back burner. During 2021, we think that central banks will absorb roughly the same amount of gold that they did in 2020. The relative softness in prices, recovery from COVID, and ongoing need among emerging market central banks to diversify their reserve assets are all factors we think that will help to support demand from this sector during the year. So as mentioned before, central bank demand for gold tends to be sensitive to gold prices. These two charts illustrate the inverse relation between gold prices and central bank gold demand, which stands at roughly a negative 66%. The relative softness in prices that we are experiencing this year should help support demand from this sector based on this relation. Now, despite ongoing net purchases by central banks over the past 12 years, mostly from developing country central banks, gold still remains a relatively small percentage of total reserves from most of these central banks. As you can see on the chart on the top panel. This tells us that there's still a large opportunity for growth in gold demand from this sector. And we think that that opportunity is greater from countries that are net exporters for example, like Russia or China, because of the larger inflows of forex that they have versus the outflows, giving them the flexibility to further diversify their forex reserves. So with that, let's talk about supply. Total supply, which is made up of mine supply and secondary supply, declined to 128.9 million ounces in 2020, which was the lowest level of supply since 2015. The decline was driven primarily by mine supply, which declined due to various COVID-related shutdowns. And while COVID played an important role in weighing on mine supply, there were also some non-COVID related issues like suspension of operations at the Porgera mine and the transition from open pit to underground at the Grasberg mine that weighed on total mine supply during 2020. Scrap supply rose in 2020 and offset some of the weakness in mine supply. That said, given how sharply gold prices rose, the increase in scrap supply was fairly muted. A couple of factors were expected to have weighed on scrap supply during 2020. One of them was the disruption in general to the scrap supply chain, and the other was a quick and large fiscal and monetary response to the pandemic, which removed or at least lessened the need to sell old gold items to raise cash, as was seen during the Great Recession. This year, we are forecasting total supply to reach about 131.2 million ounces. And this rise is expected to be driven entirely by an increase in mine supply, with scrap supply declining marginally. But still, we think that it would remain high by historic standards. So what you're looking at here is new capacity additions to mine supply, and new capacity additions during 2020 stood at about 744,000 ounces. These additions have been in a declining trend for several years, and this is expected to continue in the near term. This declining capacity already is and is expected to continue to make gold supply extremely vulnerable to the shutting down of mines due to political or public health reasons, as we've seen in the past few years. So disruptions at even of a handful of mines can have a pretty meaningful impact on mine supply because of this reduced new capacity that's been coming on stream. One thing that should be noted is that while the volume of gold that is being bought on stream has been declining, the average grade and cost profile of the new projects coming on stream is significantly stronger than those seen in the past bull market. So there's definitely an improvement in the quality of the projects that are being bought on stream. So what you're looking at here is the costs, the production weighted average costs for the gold miners, and all-in sustaining costs have been on a rising trajectory since the first quarter of 2016. This stood at about 1,058 in the third quarter of 2020, which is up about 20% since that first quarter 2016 level. The gains in all-in sustaining costs are being driven primarily by an increase in cash costs. At least a part of that increase in cash costs can be explained by the gradual increase in gold prices between 2016 and 2019 and the sharp gains that we saw in 2020. There is a positive correlation between the price of gold and costs, as rising gold prices encourage miners to mine lower grade ores typically. There's also cash cost components such as labor that cannot be easily reduced. So these factors have sort of pushed cash costs higher over the past few years. That said, mining companies have been a lot more conservative with their spending this time around compared to what was seen during the last run-up in gold prices, which should help, and we are already seeing it helping the margins for a lot of these mining companies. So that will speak about fabrication demand. It was unsurprising that gold fabrication demand declined sharply during 2020. It fell to about 77 million ounces during the year, which was about a 17% decline from 2019 levels. Around 80% of gold fabrication demand is jewelry demand, which is both price and income elastic. And as a result of the sharp increase in gold prices coupled with recessionary conditions during 2020, it collectively weighed heavily on gold fabrication demand. Fabrication demand this year, we forecast it to grow. The growth is expected to be limited, however, as customers continue to adjust to higher prices and economic recovery from the recession. Demand in India, we think, will benefit from an improvement in the Indian rupee's value versus the US dollar, as well as a lowering in certain import duties. On a global basis, we think that gold demand will reach about 81 million ounces, which is around 5% higher than where it was last year. So with that, we'll take questions, and I'll just pass this presentation back to Jeff.
Thank you, Rohit. That was very good. Hopefully Carlos is going to be plugging in and asking, managing the question flow. I don't see him back in. Here you go, Carlos. All right. You ready?
Yeah, I'm here. Okay, one of the, I guess the first question is on the demand chart. What was the red section representing? Right, if you can possibly go back to that demand chart.
The red. You want to answer, Rohit?
Yeah, that the red is basically a jewelry demand from developed countries.
Yeah, I'll add, so I guess someone might be looking at the fact that this was absolutely enormous in the 90s and it has shrunk very sharply. That is a shift. There, it used to be that an enormous amount of gold jewelry was manufactured in Italy. It's still manufactured by Italian companies in some cases, but it's now manufactured in China, India, Thailand, and Turkey, and other countries too. So you've seen a big shift in the location of manufacturing away from Europe and the United States. I mean, there are any number of jewelry companies that in the United States that now manufacture in China and other countries, in Thailand too.
Okay, next question. Is Bitcoin taking away from gold demand?
Rohit, do you want to answer that or should I?
I can take a first stab at it. I think in terms of, I mean, we got a lot of these questions in 2017 as well, when the price of Bitcoin shot up sharply. And there was a concern about whether Bitcoin would replace gold in portfolios. One of the main reasons why people think of gold and Bitcoin together is because it's thought of as a hedge against the US dollar. When we ran those correlations, we've seen that gold has actually been a more consistent and more often has been had a stronger inverse relation to the dollar, and therefore provides a better hedge than what Bitcoin does. Another thing is that gold is not just a hedge against the USD, but it also provides other benefits to an investor, such as it has shown to be a good portfolio diversifier. It has shown to be a good safe haven asset And there's no reason to think that gold and Bitcoin cannot coexist, because, for example, if you take the safe haven aspect of why some investors use gold, they also use government bonds, for example. So you could have a portfolio which has government bonds as well as gold. So there's no reason to believe that Bitcoin and gold cannot necessarily coexist. There are certain shortfalls to Bitcoin at the moment. It's a much smaller market than gold. It's a lot less liquid than gold. And unlike gold, it hasn't really been around for that long. So I think when it can compete with gold on those aspects, you probably will see a greater acceptance of Bitcoin in portfolios. At the moment, it's still, I would not consider it a major competitor to gold at this point.
I would just add, if you look at the numbers, to quote Willie Sutton, it seems to us that the big distraction of investors away from gold is to the stock market and to the bond market over the last few years, but especially the stock market. I mean, the stock market's a multi-trillion, hundreds of trillions of dollars. It's a $100 trillion stock market globally, at least, and it has quadrillions of dollars of derivatives based on it. As Rohit said, Bitcoin is relatively small compared to gold market and to the stock market, and it's much more volatile and specialized. A lot of money has poured into the stock market, which has been well managed from 2010 until recently. So I think that's a bigger distraction. I was thinking about this morning, and the thought that I had was that the enthusiasm that you see on the part of cryptocurrency investors and Tesla stock investors is similar to the enthusiasm that you saw in the tech stock boom for those thousands of companies that had a 5-page business plan, 2 kids who were just getting out of college and raised hundreds of millions, if not billions of dollars on it. And 6 of them survived. We don't necessarily see Bitcoins as a major threat or distraction. We really see the stock market as a distraction. Next question, Carlos.
Okay, next question is, given the large drop in jewelry demand last year, do you expect or not expect a significant recovery this year due to the effects of the post-COVID retail recovery?
So a couple of things on that. That we do see an improvement in demand. We do not necessarily see a very strong increase in demand because you still have gold prices which are extremely high. Gold jewelry demand tends to be pretty sensitive to high prices. Additionally, it is a discretionary purchase, so it's not something that will necessarily be the first thing that will see an increase in demand. You are seeing a recovery from the recession last year, but people are not necessarily as comfortable or as confident as one might think or one might expect the public to be. So we think a combination of the high price and the still ongoing recovery from what we had last year will sort of put a little bit of downward pressure still on gold fabrication demand this year. So that's the reason why you don't see that sharp jump up.
Next question. Do you have any thoughts about how gold transactions by the Bank for International Settlements affect the price of gold?
You want to take that one, Ro, or shall I?
I can already take that one.
Okay. Oh, did you say you wanted me to take it?
Yeah.
Okay. I think that the Bank for International Settlement, well, you know, there are various types of transactions that the Bank for International Settlement has. The major thing that it has been doing in recent years has been doing dollar gold swaps with commercial banks that need dollar liquidity. And so those dollar gold swaps, generally speaking, don't have a major effect on the gold price per se, except that what they do is they help stabilize the banking system and they provide the liquidity that the banking system needs. And that's a real issue. I mean, we didn't really talk about it, but there are significant stresses in the banking system globally, including in Europe and including in the United States. But insofar as the bank's dollar gold swaps help provide liquidity and stability to the banking system, I guess it's a negative effect on gold.
Okay. Next question. What is your outlook for gold prices this year and next year?
Bro, you want to take it?
Yeah, sure. So we do expect gold prices to rise both this year as well as next year. We do not see the same kind of sharp increases that we saw during 2020. As I explained, we think that investors will buy large volumes of gold during the year, but they are likely and are expected to be a lot more price sensitive. So we will see them being buyers of large volumes of gold, but only when we see prices soften. And they're more likely to pull back on making fresh purchases during periods when gold prices are rising. So we have gold prices on average rising about 3% over what they did last year.
Okay. We've gone a little over an hour now, and I think we're pretty much questioned out here. So I want to thank you guys for participating and listening in. I hope this was informative and useful and gives you some insights that will be helpful. As you can see on the screen, you may order the Gold Yearbook on our website. We have a store. When you go to cpmgroup.com, you'll see a store and at the top, and at that store, you can order not only our yearbooks, but other reports that we have, including the Precious Metals Advisory monthly report. The Gold Yearbook is available now. We will be launching our 2021 Silver Yearbook on May 11th. We're delaying it a few weeks simply because this is such a hectic time. We're very backed up with work, a lot of things that have to happen. We will launch the Silver Yearbook on May 11th. You'll get notices inviting you to plug into a webinar at that time. You may pre-order the book at this link, and you can also pre-order the Platinum Yearbook, which will come out on the 12th of July. I want to thank you all for your attention, and we'll see you soon. Thank you and good day.